are smoothly switching to the fourth paper presentation, and it's going to be on decarbonizing institutional investors' portfolios. So very much in the same spirit. This is Philipp Krüger from Geneva is presenting the work, and it's co-authored with Vaska, Atta-Darkua, Simon Glossner, and Pedro Matos. Yes, could you please bring up the slides? Excellent, and thanks so much, Hannes, for the long commute that you had to come to this conference and your discussion.
Thank you.
Okay, great. Thanks a lot to the organizers for inviting me and giving me the opportunity to present this paper. So this is the first time I'm presenting it, so please, be kind with me. So this is joint work with Vaska, Atta-Darkua, and Pedro Matos, who are both at the University of Virginia, Darden School of Business, and Simon Glossner, who's at the Fed. So I think I should say the usual Fed disclaimer applies. And sort of the starting point for this paper is probably something that we all know, which is that in order to limit global warming to well below 2 degrees Celsius, so to meet the target set out in the Paris Agreement, decarbonization on a massive scale is going to be required. And sort of what we do in this paper is we're interested in institutional investors. Okay? And we're interested in what institutional investors are doing in terms of decarbonization. So we ask a series of questions related to sort of the carbon emissions characteristics or profiles of institutional investors' equity portfolios. And so the first question we ask, and this is going to be settled in academic debate because I think it's going to be contrary to what Patrick just presented. But we asked this relatively simple question of whether institutional investors are decarbonizing their public equity portfolios. And contrary to what Patrick just presented, we sort of find that it is the case. So for our sample of global institutional investors and for their public equity portfolios, we find that between 2005 and 2019, on average, depending on which measure you use or which carbon measure you use, institutional investors are seeming to be reducing their emissions by between 4 to 6% per annum. So this doesn't mean that this happens every year. So this is an average estimate. So it could be that sort of in the earlier parts of the sample period, there might be decarbonizing less, and there might be decarbonizing more in the more recent periods of the sample. Now, the second question or second aspect we're interested in this paper is to get a sense of the role that these investor-led climate initiatives are playing. Okay, and so we're interested. So we study two climate initiatives, the CDP and Climate Action 100+, and we are interested in knowing or learning whether investors that are part of these initiatives, investors that we refer to as being climate-conscious investors, have better carbon profiles at the equity portfolio level. And we're also interested in knowing whether these investors decarbonize faster. Okay, that's the second question we're after. And so if we find evidence that these climate-conscious investors tend to have better carbon footprints, so lower carbon emissions at the equity portfolio level, and they also seem to be decarbonizing faster. So the third aspect we study in this paper is to get a better sense of how institutional investors are decarbonizing. And I think we already discussed this a bit today and probably yesterday as well. Essentially, there are two ways in which institutional investors could decarbonize their equity portfolios. They could do so by tilting. Okay, so this idea of tilting would be is that they overweight sort of low-emitting firms and underweight high-emitting firms. So kind of probably in the sense of these low-carbon or indices, or they could be using shareholder engagement, right? Remaining invested even in the most highly emitting firms and engaging with them so that they, these firms successively or consecutively reduce their emissions. Now, we find that tilting seems to be the predominant or most prominently used approach by institutional investors. However, we also find some evidence of shareholder engagement, in particular in later periods of the sample period. Okay, so starting after the Paris Agreement. And then the fourth part, which I won't have the time to present today, is we also look at green revenues and green patterns. To what extent are institutional investors, investing in firms that provide solutions to make the world a greener or more carbon-friendly place. And here we also find that climate-conscious investors tilt towards firms that generate higher green revenues, but not necessarily to firms that generate more patents. Okay, so in terms of data and methods, so as I said, this is a study that uses global institutional investor equity holdings, which we get from FactSet, which is sort of the standard source for this data, and we match it with greenhouse gas emissions from S&P and TrueCost. And then in terms of methodologies, we calculate several portfolio-level carbon measures. So the first one is sort of the average Scope 1 emissions at the portfolio level, so it's a cap-weighted average. And also the average Scope 1 intensity at the portfolio level. So I think these are pretty standard and sort of used in the industry. I think the industry focuses more on intensities as opposed to total emissions. And then we also construct a measure which I think is, or we think is a bit new, which we call Scope 1 footprint, which is sort of the total amount of Scope 1 emissions owned by the investor. Okay, so the idea is really to look at, how much does the investor own of the equity of the firm, and then, multiply that with the Scope 1 emissions of the firm, and then essentially summing over all holdings of the investor. Okay, so this is also an absolute measure. Now, and then we sort of look at levels and changes of these carbon measures over time. So let me jump into the first question, which is this question of whether institutional investors decarbonize their public equity portfolios. And to get at this question, we sort of take an indirect route first. So I hope you can see, these graphs. So what do we do in these graphs? So focus on the left-hand graph first. So what we do here is we map, we plot the total carbon emissions from fossil fuel use and industrial processes over time, going from 2005 to 2019. So we get this data from EDGAR. So this is not SEC EDGAR, but the emissions database for global atmospheric research, okay, so which provides estimates of the total anthropogenic greenhouse gas emissions. And then what we do is, in the first step, we split these up into the portion that is due to public firms and private firms, okay, so non-public firms. And so what you can see here is that the large part, so it's essentially this white part here, of global carbon emissions is resulting from private firms, non-public firms. Now, within public firms, we then look at, what's the fraction of all of the emissions, owned by, or let's say, generated by public firms, and apportion them to different types of investors. Okay, so the dark blue area here is essentially the portion of total emissions that we allocate to institutional investors. Okay, so institutional investors, kind of were, through their holdings, equity holdings, responsible for about 9% of global carbon emissions in 2005, but also in 2019. Okay, so that fraction doesn't change over time. Okay. Now, we all know that over the same period of time, institutional ownership has increased dramatically. okay, so the fraction of total equity, public equity owned by institutional investors has essentially gone from somewhat like 43% in 2005 to 53% in 2019. Okay, so now, if we, take this increase in public equity ownership by institutional investors and sort of square that with the fraction of emissions being flat, it kind of means that institutional investors are decarbonizing, right? Because if we assume that emissions are flat, and we just do sort of a crude approximation where we proportionally interpolate the fraction of emissions from 2005 to 2019, institutional investors should be responsible for about 15% of carbon emissions in 2019 and not for 9%. So this implies institutional investors are decarbonizing. Okay, so it's an indirect way, but we're doing this because I think there are a couple of other interesting facts that you can take from this graph. So one I've already mentioned is that essentially a lot of the emissions, greenhouse gas emissions, are actually occurring outside of public markets. Okay? So essentially outside of the control of institutional investors. But even within public markets, if you look at the areas of the graph that is highlighted with diamonds and with squares, so these are the greenhouse gas emissions that result from public firms that have minority investors, like block holders. Non-institutional type block holders, or from essentially firms that have other minority investors, such as states, right? I mean, like kind of state-controlled firms. So, somebody bought up China recently. I mean, you can see that these other types of institutional investors, are actually increasing their emissions relative to institutional investors. I think, like something to take away from this graph is also what can institutional investors actually do about emissions, given that the majority is occurring outside of public markets, and even within public markets are generated by firms that are controlled by sort of non-institutional block holders. Okay, now the second, so you have to keep me in time, I will go over time, but just yeah, exactly, good. So the second aspect we study is this role of climate, investor-led climate initiatives. Okay, so there are now like many ESG type investor initiatives. Probably the most prominent one is the PRI, which is more generally focused on ESG, but there are also specific ones focused more on climate. So I think the earliest is probably CDP, or the Carbon Disclosure Project, which was or which still is a more disclosure-oriented investor initiative, and then there are more engagement-focused ones, such as Climate Action 100, that really wants to work towards reducing emissions. So what we now do is, so if we want to know, do investors who are part of these initiatives have lower carbon footprints, or are they decarbonizing faster? Okay, so just, I mean, like I've said this already, so CDP is, the one we focus mainly on in this paper, mainly because it has been around for a longer time, so we can use the whole time series of data, whereas, Climate Action 100 Plus is more of an engagement focused investor climate initiative that kind of was born post Paris. So we also use that in some of our tests. So what you can see is that these investor initiatives have become more prominent over time. On the left-hand side, in terms of the number of investors, but I mean more importantly in terms of the equity AUM that they represent. Now, a lot of formulas, I try to, be brief on this. So what we do now is we calculate sort of 4 different carbon measures at the equity portfolio level. So the first one, which we refer to as internal, are relatively standard. I think so. This is simply sort of the average Scope 1 greenhouse gas emissions in the equity portfolio of these firms. Okay, so it's a cap-weighted average. So think about it kind of as what are the emissions of the representative firm in the portfolio of the investor, and then we also look at intensities. Okay, it's just look at Scope 1 greenhouse gas intensities, and then we refer to these measures, so one being absolute and one being sort of relative and intensity measure, as internal measures, because we think that they measure the exposure of the investor to carbon risk. Okay, so if you have higher average emissions, you're potentially more exposed to the risk of future regulation, for instance. Now we also have this set of external measures. Okay, so the external measure is, as I said already, so what we're trying to capture is like what is the total amount of emissions that the investor owns through its equity holdings. And we ignore debt here, so that's probably something we should think about at some point. Okay, so we simply take the institutional ownership of a given investor in a given firm at time t. Let's say for a big firm this is going to be at 2%. And then multiply that with the emissions that firm generates, and then just simply sum that over all holdings. Okay, so this is sort of an absolute number, and then we also scale that by sort of the portfolio size. Okay, so this would be how much do you own per dollar invested. Okay. Now, in terms quickly, like just on the two graphs, so the two graphs on the left-hand side here, so what you see is that the orange line is CDP investors, so climate-conscious investors seem to be decarbonizing. Okay, but the other investors, the blue lines as well. Okay, and they seem to be relatively similar. There might be some evidence that the slope for carbon-conscious investors, the CDP investors, is a bit steeper. But this is univariate. Okay, and the same is true for sort of the intensity measures. So when we look at this in sort of a more complete regression framework, where we also control for other investor characteristics, such as investor styles, fixed effects, the size of the investor as well, we sort of find that the coefficient here on the dummy for CDP is about, implies a 7.1% lower emissions reductions for CDP investors in the total emissions, so the average emissions of the investor, and 4.2% in the intensity measures. And we also look at the speed of decarbonization, so we simply take the log difference, okay, which is like the percentage change from one year to another, and we find that they decarbonize by somewhere between 1.4 to 3 percentage points faster. Again, these are average estimates, right? That might be higher because investors are decarbonizing quickly. Now, really quickly on the last point, I just present this. So there are essentially like two ways in which investors could decarbonize. The first way is tilting. Okay, so where in an illustrative way here you have the total CO2 footprint of the investor. The investor reduces exposure to high-emitting firms, increases exposure to low-emitting firms, thereby kind of bringing down emissions. Now, like an alternative way of doing it would be through engagement, where through engagement, the investor brings down the emissions by sort of working with the company, even the highest emitters, to reduce emissions. So what we find, and I'll do this with the concluding slide, is that we find that tilting is really the predominant strategy used by investors. Okay, so we find that even among CDP signatories, most of them do tilting. Now, we also find some evidence for engagement essentially, when we look at the top emitting firms, so when we restrict the holdings of the investors to the top emitting firms, we do find that evidence in favor of engagement. When we look at longer term changes, so 3-year changes in carbon emissions, okay, which might make sense because engagement might take longer to materialize, right? You might not see, year-on-year changes. And when we specifically look at Climate Action 100 plus investors post-Paris, we also see that, there's evidence of engagement there. Now, to conclude, I'll strike a bit of a pessimistic tone here, which is that, this predominant use of tilting and the fact that much of total carbon emissions occur outside of the control of institutional investors raises doubts about sort of the effectiveness of institutional investors in reducing the negative impact of firm-level carbon emissions on global warming. They might, make their portfolios look better, aligned, but it's not going to make the negative externality go away because, as we see in the first graph I showed, the ownership is just going to be picked up by other types, non-institutional type block holders in public markets, or is just going to be, divested into private markets. So thanks a lot for your attention, and sorry for going over time.
Thanks so much. Hannes, the floor is literally yours.
Okay. Is it okay to stand up? Yeah, okay, let's. Slides, please. Okay, well, let me just say it's an enormous pleasure to have everyone physically on campus because that hasn't happened for a while. Let me also say, because it's kind of a running joke that I keep making during the conference, our brand new business school campus that we just opened when the pandemic hit is 200 meters over there, and it has an Olympic-size swimming pool that you're all free to use. It's not free to use because we are a private university, but it's a fantastic pool to use. So if you're looking for something to do in the afternoon or early evening, that would be what you should be doing. You can edit that out later, just. Okay, so very good. I cannot see the slides here. So this is, okay, this is interesting. This was working before and now it's not working? Okay. Can you fix that? Otherwise, I'll just go over here, yeah? Okay, so thank you for giving me the opportunity to present and, discuss the paper. Can I, no? Okay. By Philipp and co-authors, I'll just stay back there. Okay, is it working now? Okay. This never ever happens in our courses. Okay. Now, what's the research question? The research question is that we know that large institutional investors have committed themselves in lots of different ways to address climate change in a meaningful way. And a very popular pledge would be this one, so net zero by 2050. And the question that the paper asks is, well, are such commitments actually visible in lower emissions, measurable lower emissions, and not words in the actual portfolios? And this is empirically a relatively challenging question, because it turns out if you say lower emissions, well, lower than what, okay? And if you say lower emissions, well, what kind of emissions and how do you actually measure them? Now, in case you find that emissions are actually lower, the question is why? And there are two ways. So do you actually find that it's the same firms that have lower emissions? And this would presumably be the result of engagement with the firm by the investors, so stewardship and active ownership and all these ideas. Or do you find that the portfolios actually contain now firms with lower emissions and you've just tilted away from the dirty firms or the emitting firms, the brown assets? And the results of the paper are, that yes, portfolios do have lower emissions over time, and those lower emissions are primarily because of reduced holdings in polluting firms, and not much evidence of firms actually polluting less, okay? So the conclusion is that if you're a sustainability-minded investor, as most investors nowadays are, you know, the contribution that investors are making, if I try to make this a bit black and white and controversial, it's kind of underwhelming, okay? It's very underwhelming, the evidence, and this is why the authors say, you know, our analysis, at least in the version that I had, probably now you have another 20 tables because it's a week later, our analysis raises some doubts about the effectiveness of investor initiatives in reducing carbon emissions, and you would probably agree reading the paper. I think this is fascinating evidence, and I, you know, just apply my favorite test for a paper, which is courtesy of Zhao. Zhao says, you know, you should always ask 3 questions, and if you get 3 yeses, then this is a paper that is worthwhile reading. First question is this an important topic? And the answer is unquestionably yes. And Zhao's second question is, do I learn something from reading the paper? And this is unquestionably true, at least from myself. I learned a lot from reading the paper. So thank you for the lesson that the paper teaches. And then, crucial, do I want to know more? And here the paper also gets a yes. Yeah, I want to know more about this. So, very good news. This is a paper that I think you should read. What I will do, with your permission, I'll just skip, you know, a repetition of the results. I go straight to my comments. They are not in order of importance at all. Now, my first comment is how you actually measure emissions. This is more expositional of the paper. So I was looking at, you know, with the referee eye. There are several metrics for how exactly you measure emissions. I think there are 4 main ones in the paper. Of course, if you think about how do you measure the emissions of an investor portfolio, it turns out you actually need to think a little bit how to do this. And I think in the paper they are all well developed. You have thought about this. They are all interesting, and they actually measure economically different things, but it takes time, and it takes space, and it clutters up the paper. And you know, I think not for all tests, we need all of them. My suggestion would be to maybe have one main one that is kind of the best for the actual message of the paper, and then only use the other ones for those specific tests where they generate additional economic insights. Where they generate no insights, you know, just ignore, put them into appendix. We don't particularly care, maybe. Yeah, it's too complicated. The question that I have maybe attached to this is, and I'm guessing it's hard, there is this question with all these emissions data, can you do anything about the double counting? There was a nice article last year in The Economist that outlined how complicated this actually is. I didn't know. I thought, yes, that is, you know, if the paper, there would be a question that I would ask, and if the paper has an answer, I would be extremely grateful. My second comment is on engagement. And the paper, just to recap, so the paper decomposes the change in portfolio emissions of institutional investors into those changes that come from portfolio weights and those changes in actual firms' emissions that are within the portfolio. And the paper, as I said, and as Philipp said and explained well, 2 represents the engagement, okay? So the firm is actually changing. And the paper shows, just to remind you, that it's not really about engagement at all. It's mostly just not owning, not to choose not to own these assets. So it doesn't come from number 2. Now, here is the challenge that I currently see in the paper. Firms changing their actual emissions may or may not come from engagement. And this is not something that the paper can pin down right now, because technology changes could change emissions. You know, the business mix of the company obviously will change the emissions. They might just cut costs to avoid carbon permits and so on. M&A and you know, divestitures will enormously change the emissions. None of this is necessarily related to investor engagement. It might be, but right now the evidence in the paper, you know, leaves this open. And I think my suggestion is, my reading of the paper is, you have really 2 options here how you want to deal with this. Either you actually dig, right, and you show the mechanisms for engagement, and for example, shareholder voting, not sure, it's complicated, and the problem is it has to be causal, and this is always hard. Or you acknowledge this is not a big deal to begin with, So whatever it is that engagement represents, it's going to be tiny, even if we consider it as a high watermark of what we measure. Not all of it is going to be engagement. It's disappointing, okay? So my suggestion is to go for number 2 rather than to go for 1, because it may be just a distraction in the paper if you try to go down that particular rabbit hole, and it's not really the focus of the paper, right? The focus of the paper is the disappointment, not the engagement. My last comment is the incentives of the buyers and the sellers. And here I thought this might be something where you can take the paper maybe one step further. I think it's hard, but it would be, I think, so interesting. So when institutional investors tilt their portfolios against emissions, there are only 2 things you can do if you do something, right? You either increase or you decrease. Someone else obviously tilts up. And the narrative that I think we are most familiar with is that private companies buy the brown assets that public companies divest. And if you look for case studies, there are thousands of them. This is a big one. ConocoPhillips, for example, which is traded on the New York Stock Exchange, reduced its emissions in 2017 by a quarter almost. How? Well, by selling a large chunk of their assets to Hilcorp. Hilcorp 2 years ago was the largest emitter of methane in the US. And of course, it's a private firm from Texas. Can I say this? Yes. It might be a nice extension to try to disaggregate, which is not the focus of the paper now, but it could be one, how much of portfolio tilting away eventually ends up in privately owned firms. That would be a very nice and cool feature, I think, of the paper. So putting it differently, you would try to illuminate the direction of the flow of the emissions, where it actually goes away from the institutional investors. A related issue that I think is coming in here, which wasn't an issue 2 years ago, but it's very much an issue now, is that it's kind of interesting whether these portfolio tilts are actually violating the fiduciary duties of the institutional investors, also given recent legislation in Florida and Texas and other jurisdictions. So this is a potentially very big issue during the next few years, right? So can you maybe shed some light? Can you anchor this in the introduction? Could be very interesting. Is this actually legal? I'm wondering. Minor comments, you know, for all kinds of cleanup. I've read it in detail, you can tell. And I just want to say it's a very interesting paper. I learned a lot. I think you will learn something from reading the paper, and I thank you for allowing me to read it. Thank you.
Thanks so much. Would you like to respond to?
Yeah, thanks a lot for these great comments. So, I mean, I agree with all of it. So I think maybe I'll just pick up 2, which is like obviously on engagement. You're right. I probably brushed over this too fast. So let's say if firm emissions go down, you know, that is perhaps, you know, also due to many other factors. And I think we say this in the paper somewhere, but we probably should feature it more prominently as well. And I really like also the you know, the comment on buyers and sellers. We could even do that in public markets, right? Because that's something that, you know, the first figure shows that, you know, actually some other type of, or let's say, non-institutional block holders are increasing their exposure to, you know, carbon-heavy public assets even. And we also, you know, discussed a bit this possibility of looking at spin-offs, but it's almost like a, you know, separate paper, right? I mean, like kind of looking at, you know, like this, you know, practice of brown spinning. But, you know, thanks a lot for all these comments. They're all well taken. It's still a, you know, a first draft of the paper, so we'll you know, I'll report back to the team, and we'll all take them very, very, very seriously. Thank you.
Thank you.
Thanks so much. May I ask, do you have any comments, questions, Laurent and Patrick?
So I'm wondering, when you're looking at the engagement, whether it is, if you look, since only the largest firms get engaged, if you just look at the largest firms instead of the whole portfolio, maybe you'd get more evidence about engagement.
That's a great point. So what we do find is that when we limit to firms where we know that there should be engagement, right? So those that are on the Climate Action 100 plus list, so these 167 firms, there we find in our test that actually there is engagement, right? And I completely, so when we really focus on and also on the top 100 emitters, right, where you would think, if engagement is going on, it's probably going on, with the top emitters, but I completely agree with you. Maybe it's like larger firms as well. We could also do that. So kind of restrict the sample to, let's say, a subset of firms where one would expect. But we have some tests along those lines in the paper, but it's a great suggestion also looking at larger firms.
Patrick?
Yeah, a great paper, Philipp. This is more a suggestion for other things you could, explore. Seem like low-hanging fruits. You could look at whether things look different in Europe versus North America versus Asia. And then you can also look at where the tilt is happening in which sectors, whether it's primarily the energy sector, the salient sectors, how it looks across different sectors.
So for the first one, not enough time to present all of it. I struggled to put this into 20 minutes, but we actually find exactly that tilting is much more prominent among European CDP investors. So the tilting is happening there. So we haven't really thought about which kind of sectors are they including? Are they perhaps doing best in class? That's perhaps something one could look at. Or are they excluding complete sectors? So it's another great suggestion. But for the, let's say, geographical sub-results, so we do find stronger effects in Europe. I think there's sort of two possible explanations. Maybe because there's been carbon pricing around for a longer time, but there's also kind of an observationally equivalent hypothesis, which is related to values, right? I mean, we all know that let's say there are very strong differences in terms of the ESG characteristics of institutional investors between the US and for instance, right, and Europe or other parts of the world. But that's also something we're already digging into.
Yes.
Thank you. I see that the first main objectives try to determine whether or not the public investors are decarbonizing by looking at the market value. I just wonder, as an alternative way, whether one can actually compare the CO2 emissions to actually what is done in debt. So you look at finance emissions. So rather than market value, but actually looking at capital deployed, and eventually at what is actually the amount of actually invested, because I have a feeling that obviously the market value is affected by other elements, which arguably, at least on the debt side, you look at the financed rather than the value of the debt underlining whether it becomes an NPE or goes up and down.
I completely agree. I think debt, which we've ignored completely for the moment, one reason is we look at investor holdings, and investor holdings of debt is always less available, right? We know much less about which institutional investors hold debt. So it would be interesting looking at that, and also I guess because debt plays a role. I think there's some evidence that firms that rely more on debt financing actually are also kind of from more carbon heavy industries, right? So there's even sort of an economic argument to looking into debt further. It's something we have on a to-do list, and we'll see what we can do in this respect.
David?
Thanks a lot, Philipp, for this great presentation. A couple of suggestions. Maybe you could have a look at the proportion of investors who tilted the companies that are becoming green. So you look at or becoming green in the years after. So you look at with a lead on your data. The proportion of investors who did so, I guess that has increased over time. And the second one is you could probably look at the interaction between carbon emissions and engagement. So did the fund that engage a lot did they do so with very brown companies? If they hadn't engaged with these companies, would they have a greener portfolio? Yeah, so probably an interaction.
Yeah, great suggestions for the first one. I have to think a bit more how we would do that. It's kind of like getting at, are they tilting towards the right companies? That's an interesting point. In terms of like which companies are they engaging with? Yeah, I mean like they're really engaging with in the test where we find engagement is happening. It's the highest emitters, right? I mean cement and oil and gas companies, right?
Marco.
Yeah, I mean, great paper. So I'm just wondering whether it makes so much sense to mix CDP and Climate Action 100 Plus, because the logic of Climate Action 100 Plus is completely different. They take the largest carbon emitters in the world, they engage with them, they want to change. So in some sense, you do want to hold the stakes to have the voting power. So the logic of these people is really quite different to CDP. That's just much more tilting. It has much more tilting built in, so to speak.
Yeah, that's a great point. I mean, you're completely right. I mean, CDP is a disclosure-oriented initiative. Why do we rely so heavily on CDP? Is basically because we can use the whole time series, right? I mean, Climate Action 100 Plus is later, and sort of when we have some tests in the paper, we actually look at both. So we look at CDP. Only Climate Action 100 Plus and CDP and Climate Action 100 Plus. So we really look at like which investor initiatives do they belong to, and it's really the ones that are only in Climate Action 100 Plus where you see the most engagement, because perhaps like CDP membership is kind of, it's not very costly. You kind of support CDP, they collect the data, but whereas for Climate Action 100 Plus, you're actually expected to engage, right? So in these tests, it really seems to be these investors that actually are not part of CDP, but are part of Climate Action 100 Plus that engage. But I kind of it was so difficult putting all of this into 20 minutes. So I just suggest I send you the paper and you can look at that, and then I'll be more than happy to discuss more.
Thank you for the interesting presentation. I would have also one question on engagement. So as the evidence you've shown, they are actually committed to decarbonizing, but they prefer so by tilting rather than by engaging. And the question is just because tilting is faster, you just step out from a company, while engaging is time consuming, is a battle within the company, and this could be one answer, or is because they simply lack proper tools to engage. So because if the answer is the second, maybe one could conclude that company law should empower more such investors to count more within the company rather than escaping and buy from dirty companies.
I think it's kind of related a bit to like the economics behind it, or like the economic mechanism. So I mean, I think you're right when you say that with tilting you probably get results much quicker. In terms of looking like having your portfolio look more climate aligned, whereas like engagement obviously takes longer. It takes more resources. You have to engage with the companies. It's more costly. Yeah, I mean, we haven't really looked at like why they do this, but let's say my gut feeling would be, yeah, I mean, like you tilt, right, because you get like results immediately. I mean, maybe because you have like some beneficiaries, your pension fund, and you have to show that you like climate aligned, or you like the public pension fund in Geneva is not even allowed to hold like oil and gas companies, so they would obviously also. It's a public pension fund, right? But so I think like with tilting, you can get results in terms of your portfolio much quicker. And I think like with Laura also we have work on why do institutional investors do this, and like why do they take into consideration climate aspects? And so one thing that not stands out, but an important aspect is reputational concerns, right? So you don't want to like your public pension fund, and people see that you hold like oil and gas companies, so it's easy for you to just divest that. I mean, relatively easy. I mean, there are costs associated with it, obviously in the mid or in the short term or medium term.
So if I may ask or add to that comment related to this, I think it would be, maybe you're already doing it, but I think it would be interesting to look at the dynamics, correct? T+1, T+2, T+3. As you say, engagement might take longer to realize. And so it would be interesting to understand
So
if there's actually engagement, you would expect that the emissions decrease in the longer term more likely than in the short
So
term.
when we look at T+3, we find effects, right? I mean, so that's also, so let's say we find evidence of engagement among the largest emitters. When we look at T+3, changes over a 3-year period, which kind of makes sense. And also when we specifically look at Climate Action 100 companies, so top emitters over a longer period of time, and Climate Action 100 investors seem to be engaging more.
I don't see another hand, but I do have another question / comment, if I may. So if I understand it correctly, you're looking at scope 1. And I think, your results that there's primarily tilting as opposed to actually engagement is already quite depressing by itself. But you're actually looking at scope 1. You're not looking at scope 2 and scope 3. And I think it would be very, thinking about the broader system and what actually changes, it would be good to understand.
We do look at, in the paper, we do look at scope 2 and 3 as well. Impossible to fit into 20 minutes.
So do they actually tilt away?
No. So there's
companies?
it seems to be like the results for 2+3, scope 2 and 3, but we probably should also separate 2 and 3, are much weaker. Okay, so much less statistically significant. So we don't see that, because there are multiple hypotheses, there could be this kind of outsourcing thing, are they kind of, going towards scope 3 firms? So we don't find a lot of evidence for scope 2 and 3.
But from the global perspective, this is even more concerning, right?
Yeah, of course.
Essentially, there's tilting going on primarily, but in addition, they are not necessarily even tilting away from carbon intensive companies.
Like the scope 2 ones, right?
Because you have scope 2 and scope 3 in there.
Yeah, but it's kind of like a bit like the conclusion is a bit pessimistic, right? I mean, we probably should say a bit more about scope 2 and 3 as well in the presentation.
Any other questions? Or you're ready for the panel? All right, so thank you so much, Philipp and Hannes.